Absolutely. Well, let's just talk about that sequencing. The language from the Fed remains very clear. We are going to defeat inflation. The bigger risk from our point of view right now is that we do too little, not too much. Isn't therefore the kind of the base case still that the Fed in particular is going to keep its foot firmly on the brake at this point until it sees basically inflation coming down very sharply towards target?
Well, the Fed is definitely going to raise rates at its next meeting and its next two meetings, and probably 75 bips, maybe 50. And then we get into sort of September and what happens then. And that's where, November, September meeting, the market's starting to think about it. And actually, we've taken 25 basis points out of the rate hikes for 2022 if you looked at the end of the year. So in the last 2 weeks, the market's already taking some of the hikes out. So yeah, sure, the Fed's language still is very hawkish. It's very, we heard Powell last week, pretty robust about defeating inflation. And absolutely, they're going to do that. And they're going to want to see inflation come down. But look at the growth rate in M2 money supply in the States. It is now growing meaningfully less than nominal GDP. So if you think inflation's running at 7, 8, 9, nominal GDP is probably not that far off, 10-ish. And then, of course, M2 money supply is growing about 6. So it's much slower than the growth rate of nominal GDP, which suggests it's actually not enough money to service this growth, which means inflation should slow from here. So we could see inflation come down pretty fast over the course of the second half of the year. And that could change a lot of the Fed's rhetoric as you get into the end of Q3, beginning of Q4. But as I say, the market moves ahead of the Fed, and it's started to move in the last 2 weeks in quite a big way.
So